Let's continue the conversation now with Apollo Global Management Chief Economist Torsten Slok, and here at Post 9, Citigroup U.S. equity strategist Scott Chronert. Scott, perhaps the biggest surprise of it all is just the market and the resilience that we've seen and this sort of newfound enthusiasm for the market. What do you chalk it up to as someone who was not expecting this to happen, right?
Yeah. Well, I think we've got the euphoria around AI. It's driven the growth component of the market, whether it's the NASDAQ components or whether it's our broader growth cluster. You're looking at a 33% gain year to date. This is relative to the cyclical side of the market, which is down 1%, and defensive's down 4 to 5%. So this is not a broader market move. This is a very narrow move, if you will, from that perspective. It's predicated on long-term promise, where our concern is that that long-term promise isn't yet showing up in the fundamentals. It'll take some time for that to happen. We think it'll happen. But between here and there, we think we're probably setting up for a bit of a digestion phase during the second half.
It is broad in this month of June. Materials are up 7.5%, energy up 7%, industrials are up. So in recent days and weeks, It's broadened out.
So when you begin to get news like today on the CPI front, at the margin, it takes some of the pressure off of this Fed expected trajectory, takes some of the recession risk off. I think actually it sets up for a release valve higher for the cyclical side of the market, which has been our call in terms of where we want to position with new money at this point.
Torsten, what about you? What do you expect the Fed to do, and how do you think that'll shape expectations for the market?
You said it very well, Sarah. They are still not done. Core inflation actually was higher than expected, and we are still at more than 5% on core PCE. You see how rates are trading here after the number. First, the gut reaction was to say, okay, well, inflation on the headline was lower than expected because energy prices year over year are definitely coming down. But if you look at the core components, yes, super core was maybe a little bit better. But the bottom line still is the housing market. Housing makes up 40% of the CPI basket. And if everyone now says, oh, green light, everything is fine, housing can start to go up again, we run the risk that 40% of the basket is not going to come down, but it's a risk of beginning to go up over the coming quarters. And that raises the risk that we're not going to go down to 2%. So there's a lot of things. If we get a relief rally, not only in markets, but also in the economy, everyone's saying, oh, everything is fine. That's ironically a major problem for the Fed, because that's going to put more upward pressure on inflation. And at these levels of around 5%, that still is just too elevated.
I don't get why they're not hiking tomorrow, why the market is so convinced of this. And clearly they've messaged that, so that's probably why the market's convinced of it. But, you could have an argument that PCE came in stronger than expected. We're still at too high inflation levels. They're supposed to be targeting inflation. And yes, while there are signs of weakness in demand and the economy, the labor market hasn't broken, and regional banks are up 20% from their year-to-date lows. So why not keep going?
Absolutely. Absolutely. There's, as you can see in the FOMC members' speeches, there's a very important debate about this. Some FOMC members, Laurie Logan, you also had Laura Demesta, Jim Bullard, have been more in the camp of saying, everything you just listed, we got to keep going. We're still far away at 5% from our 2% target. Others, and Jay Powell probably falls in that camp, are saying, well, why don't we just take a break or a skip and figure out what's going on? But the market is certainly underestimating, in my view, the risks that rates are going to stay higher for longer. At the moment, the market is pricing a cut already in November. But all FOMC members, even the three ones I just mentioned, the more hawkish ones, everyone is here saying, well, we are at least going to keep rates at these levels well into next year. So you're absolutely right. It depends on, when you put all this up on the scale, what gets the most weight. And different individuals have different views on that. But where we sit at the moment, I completely agree that the risks at the moment are tilted more towards higher for longer.